Welcome back to the Dash Trader Newsroom. The question of the day is, will the banks be the next group of companies to have their credit rating cut by Fitch and S&P? My name is Michael DeGioia, and I'm the Director of Education at Dash Trader. And I'm joined by my co-host, Jill Malandrino, Global Markets Reporter from NASDAQ. Jill, how are you?
Good, doing well. Good to see you, Mike.
Good to see you. Good to have you back in the NASDAQ market site and here with us, of course. And let's just jump in. I mean, there was a big move up in treasuries today. This is the biggest or highest point since October of 2022. So the move was triggered by the Fed minutes from July having been released. So the Fed releases its minutes from the prior month, generally 1 month later. And obviously that has an effect because once you actually see what they're thinking, that does have effect on, bond prices and, of course, stock prices as well. As we saw, the stock market was down today. So what are your thoughts, as far as, the impact of the 10-year reaching its highest point since October of 2022?
Well, I mean, the Fed's risk remains in just stubborn inflation. And while we've seen a trend somewhat in the right direction, they really haven't gotten to the core number that the Fed needs to see. Housing prices remain stubbornly high. Rents, wages, of course, obviously to keep up with inflation, you need to pay your workers more. They haven't signaled anything that they're pausing or they're going to cut rates for this year at all. I'd be surprised if you even see any rate cuts into the beginning of, certainly the first quarter, perhaps the first half of next year. So I think that's kind of what the bond market is grappling with. But Mike, the whole point of this, 525 basis points ago, just, over a year ago, is that the bond market and equity markets are signaling two very different things, right? So it appears to be that, the bond market is right. It's a little bit nervous. It's signaling that they don't see a shift in policy. So it appears it's going to be rates, higher for longer. I think, the Jackson Hole meeting next week is going to be key. Of course, commentary is going to move the markets there for sure. So of course we'll be, taking a look at the bond market. I also think, when you look at the August action anyway, it's August trade, right? We're kind of in this vacuum of the news cycle with earnings largely over. Everyone's focused on macro. I mean, the indexes are up, particularly the NASDAQ 100 had a fantastic run this year. So,
yeah.
It's a challenge finding new money to put for work in certain sectors of the market. And, I can tell you the general consensus of guests that we've had on the show here, whether it's analysts, portfolio strategies, different data companies, trying to get a read into it, is that it could be more volatile of the back half of the year than we saw in the first half. And if anything, we probably see some, range bound trade versus the trajectory that we saw the first half of the year.
Okay, very good point. Let's just jump on to our next item for today, which is kind of similar. Obviously the 10-year going higher and bond rates overall make up a big component of, banks' balance sheets. But earlier this year, we saw that U.S. sovereign debt rating was cut, and you made the good point that it was kind of like from excellent to, okay, good. So the U.S. sovereign debt rating went from AAA to double A plus, and now Fitch warned that potentially the banks might be next, and the big banks, but certainly some of the more regional banks. And what is the correlation between these two events, in your opinion?
So I think the challenge is here, and I'm surprised the market didn't react to it a little bit more than meets the eye here. You kind of will have that snowball effect, if you will. So if you take down, let's look for example here, double A minus, you have Bank of America, Bank of New York Mellon, JP Morgan, State Street, right? A plus is Morgan Stanley and Wells Fargo. So two larger institutions like that, or even below that. Single A, you have BOK Financial, Citigroup, Goldman Sachs, UMB Financial. So a lot of these household names that we know, if for some reason you were to get a cut like a JP Morgan Chase from double A minus to A plus, then you have to worry about, okay, what do the lower tiers, do they start to get cut from there? So that's kind of the snowball effect that they're thinking of. I think, if Fitch were to downgrade the industry, I guess the biggest factor is the path of interest rates and what the Fed decides to do, right? Because whether they're done raising rates or not, they're still in a higher rate environment for longer. And of course, that puts pressures on the industry's profit margins. We've heard it in all of the earnings reports. Deposits are going elsewhere for higher yielding accounts, and they're not really doing as much lending as they used to. A lot of this is being done by either through private credit or for through other fintech companies, such as a SoFi as an example. So, not only are higher rates a pressure on their balance sheets, but, looking for product elsewhere and not going to traditional institutions is another thing that the industry is facing. So I don't know if it'd be shocking or alarming, but it's more of it trickling down through the industry after, the U.S. just getting a downgrade and Moody's downgrading a handful of banks.
Yes, absolutely. I mean, that's a good point. And as you were talking, I was just thinking to myself, at what point when you start to get higher yields in the bank and or for, just basic debt instruments, right? So, what point does that start to affect the returns of the stock market? If you could put your money in the bank or in CDs or into debt instruments and get, 6, 7%, 8%, and if you're going to corporates, at what point does that take the wind out of the sails of the stock market? For a long time, for many years, you and I were both saying, the market was up on, NOLA, no other logical alternative to put your money. So people were putting their money in the stock market. At what point does that start to affect the stock market, that rates and fixed incomes are really becoming a viable alternative, regardless of the credit rating, right? If you're going to go into lower credit ratings, you're going to get higher yield.
Well, I mean, the challenges with the banks, if they were to get downgraded, the sector as a whole, right, they would have to pay investors more to buy their bonds. Just like, I mean, this is kind of bond market 101. If your credit rating is lower, for investors to take on that risk, you're going to have to pay them more in the coupon because they're taking that risk on. So that would further compress profit margins as well if they have higher interest payments to pay out.
Absolutely. And of course but what I'm saying is that might impact the stock market in that people might choose to put their money in fixed incomes as they're yielding higher to take on the risk of the stock market. If you're going to get, like, as long as the company doesn't go out of business, right? You put your money into, corporate bonds from banks, right? Because their credit rating is lower, the rates go up, you're going to receive a higher rate of return for holding bank debt potentially. It could potentially put a dampen on the stock market performance is basically what at what point do higher interest rates put a damper on stock market performance? Now, obviously, we've had low interest rates for so long, like 13, 14 years of low interest rates. We haven't had to think about this in a while.
Yeah, but that's a great point that you make, because if you're going to take on the risk as an equity holder, and well, let me step back for a minute here. A lot of money went into banks because they paid dividends. They started paying dividends, again, after the financial crisis, and they typically are more stable and they continue to grow. And not even just the bank sector, but anyone that had a healthy dividend, particularly in the growth side of it. But if the risk is in the equity because margins are being compressed, you might not go there since you can get the yield in fixed income. So to your point, perhaps people will look to buy bank bonds for that yield and not take the risk as an equity holder.
That was exactly my point. And also, what is the tipping point in general that fixed income becomes a viable alternative to the equity market? Because most people have been leaning towards putting their money. I mean, there's really been the equity desk has been the place of action versus fixed income for a very long time on Wall Street. And it's interesting because many of us, haven't seen that other side of Wall Street for quite a period, quite a long time, because we've had this, this period of quantitative easing and low interest rates.
Yeah, well, 60-40 is definitely back in favor. That's for sure.
Yeah. So the last thing is, and I mean, this is kind of a logical conclusion of that train of thought, right? I mean, if you have inflation and you have persistent inflation, labor unions become more active in demanding higher wages. Now, we already saw this with the, I've been seeing all these meme jokes around the internet. I'm going to work for UPS to get $170,000 a year or whatever. You see all these jokes pass around the internet, but it's not just UPS. It's many of the many of the other unions as well that are starting to clamor for higher wages. And I saw a report out today that there's a looming auto workers strike, which could cost $5 billion in just 10 days. And what could this mean for the overall economy? I mean, what are your thoughts on unions demanding higher wages, which is logical considering that we've had a prolonged period of inflation?
Yeah, well, there's a number of reasons here, not even just economic, but I would also argue social issues as well. So the divergence between executive pay and worker pay is the biggest that it's been. I mean, CEOs make nearly 1,000% times more than some of their lower level workers. We know inflation has accelerated at a pace that certainly wages haven't. Even if you get a 4% wage stay ahead with inflation, we were looking at 9%. The numbers just don't make sense. I think another thing is one job should be enough for Americans. We depend on UPS to ship our goods internationally. And it's not even just UPS. You have the labor unions in Vegas, so the food service workers. These are the people that did not have the option of hybrid work or working from home that really kept the economy and the system going and taking, keeping that going. Imagine if these type of service workers didn't exist. So it's not a surprise to see that there, but there's a couple of things. I mean, clearly, if wages increase, it's going to apply pressure on margins from an equity holder perspective. However, if there is more disposable income, what does that mean for the economy, right?
Yeah.
They're going to be able to spend it in other areas. So, the consumer is 69-70% of American GDP. So there's going to be benefits. There's going to be, and some people are not going to benefit from it. But I think if you were to ask the average person, perhaps not related to the stock market as much as we are, they want to see the divergence of the upper class and middle class, kind of come back more to the medium. There really is no more middle class. And, for the economy, it's good if you have more disposable income. And again, as a shareholder, well, you probably have to get through the margin pressure pain for a few quarters, but it's really hard.
For companies in earnings seasons going forward, obviously labor and cost of labor is one of the biggest factors on their balance sheet. So, I mean, that has a big impact on corporate earnings. So as labor starts to increase in its, expense and labor expenses continue to increase, certainly that will impact corporate earnings. And then you also have this other implied pressure, which is obviously just stocks in general. Are competing with fixed income and bond prices. So if fixed income and bond yields are higher, that makes equities less attractive at the same time that equities are also facing pressure from potential earnings reduction because of added costs. So costs go up and equities at the same time are also not as attractive when considered against fixed income potentially. Yeah.
Yeah, but there's a couple of things at play here as well, right? So, as we saw what happened with Target, they were blaming, their miss on the quarter with shrinkflation, or what they're saying with inventory loss, if you will, and they have raised their prices to make up for that with margin compression. Yeah. So at the end of the day, it's it's always going to be passed down to the consumer. Right. Yes. Because they have a responsibility to the shareholder, for better or for worse. But what's going to happen is it's going to get pressed down to the consumer. And we saw that. Right. We saw Walmart have a very different quarter, and you can blame that on social issues. But they haven't taken up their prices like Target, and the consumer's making, is expressing themselves by shopping where they want to shop. So it's the cost will trickle through. That's the point.
Yeah, I mean, the market always finds the point of equilibrium, right? So there's always that happy point, and there's a point where things are out of balance, but then they come back into balance. But the excellent point. And so far, everybody has been amazed at the resilience of the economy. And until next time, I'll see you in 2 weeks, and I'll see you at the NASDAQ opening on. Are you going to be there for September 7th? I think there was.
Yes, I will.
Yes, so I'll see you there.
Okay.
See you in person. All the best. Bye now.
Thank you.
All right. So let's first bring up the daily chart on. Let's go to our dash trader here, and let's pull up the daily chart on the SPY. So basically, we've had 3 pretty significant down days. Now, I'm going to actually go a little bit further back in time. I'm going to actually go to data config, and I'm going to go back to 2022, 2021. Hit OK. So this is what I wanted to show, is that we have a bullish green bar on the monthly in July, and now we basically have a bearish engulfing bar on the on the monthly here in the in the S&P. And if I put it on the QQQ, now technical analysis works better when you have when you have more data. So the fact that we have an all-time market high here established after the pandemic, then we fail to make a higher high on NASDAQ and on on the NASDAQ technology stocks. This is technically this is obviously it's August 17th. This is technically a monthly trigger to the downside. So we've been up for 1, 2, 3, well, pretty much 1, 2, 3, 4, 5, 6 months this year. And now we have triggered down for the first time. After making a high, we've made a shallow, well, actually, we did not make a higher high. So when the market fails to make a higher high, it should make a lower low. The question is whether that lower low is going to be taking out this low, or if it's just going to come back to the moving averages, which are on the QQQ, that's in the 320 to 325 level. On the SPY, we're at 436, but we're probably going to be in the 415 level. So the question is how low will we go? Because we basically triggered a trigger down on the monthly chart of both the QQQ and the S&P. And if you look at the QQQ is more bearish than the SPY. So the QQQ already broke the prior bar's low. That basically is the trigger. If we go to our weekly, we've been down for 3 straight weeks on the QQQ. And we are, basically, and we are at support. So we are below our moving averages. All that it indicates is, and then here you can see the price on volume indicating that at 295, that is the point of control. All this is indicating, that it's, it's getting pretty far to the downside. Anyway, let's take a look at some other stocks like AAPL. Right, Apple, really taking a big hit here, big drop down on Apple. Beautiful trend to the upside, but from 197, losing 25 points fairly quickly. MSFT, also off its highs. AMZN, and when the leaders are off their highs, Amazon's not too bad. GOOG, Google is probably doing the best. Meta also off its highs. So, when the leaders are going and showing some signs of pressure, certainly you should take note that there's something going on here that might have some longer term ramifications. Now, albeit we are in the middle of summer, and this is kind of the lowest volume time of year, the last 2 weeks of August, but there is certainly a stealth move to the downside that's picking up a little bit of momentum here. Also, gold, not indicating that it's going to go higher. It did look like it was going to break out to the upside, but subsequently it does now have a head and shoulders. GBTC, which is the tracking stock of Bitcoin. Bitcoin has been stair-stepping up, but certainly has slowed. GBTC, then the last one. And the final one, last one, but not least, I think that this is the one that really poses the biggest potential threat of bringing back inflation in earnest is oil. This is the oil ETN, right? And then we have oil ETN, and we also have oil ETN, and I'm just going to be USO. So this is already a tremendous run up on US oil. You could also look at the longer term chart, which is USL. We've moved off the lows. Oil prices are showing higher at the pump. Then oil is the prime commodity. Pretty much everything needs oil to get to where it's going, whether it's short term, long term. Getting to your corner store. If it's a bottle of Coke on the corner store, it's probably getting there by oil. So it certainly is something for us to be aware of, that potentially inflation is going to be on the upswing. So that was the wraps up the market analysis section. So the market analysis section, to sum it all up, is that we need to be cautious and aware going into the middle of August and certainly September. Stay up to date with all things DAS by signing up to our monthly newsletters. Simply fill out the form at the bottom of our website at www.dastrader.com. Subscribe to our YouTube channel at DAS Trader TV and DAS Newsroom reminders. Follow us on social media, LinkedIn, Twitter, Facebook, Instagram. Thank you so much for joining us. Please beware. Note that that a couple of the fundamental indicators are showing some possible dark clouds in the distance, and certainly that monthly chart is something that does not happen too often. But trade well, everybody, and see you next time.